fun.
Point. I'm your host, Neeraj Shah, and it's the penultimate day, or not even the day, the penultimate last few hours before we hear the big decision from the Fed. And that could prove to be a big event from a markets or risk assets perspective. Could it be that big, or is it kind of priced in as well? Let's try and talk about all of that and the India view with Ajay Tyagi of UTI AMC, head of equities, joins us right now on the show. Ajay, good having you. Thanks much for joining in. Hope all is well. Uh, how how crucial do you think the upcoming Fed meet could be for risk assets worldwide?
Yeah, good morning, Neeraj, and thanks for having me here on the show. So, I think it is critical because we have seen a lot of incremental things happen in the last 10 days. I mean, had the episode related to the Silicon Valley Bank, to some of the other regional banks, to the Credit Suisse in Europe, had all of these events not have happened, I would say this was another policy where possibly Fed could have hiked either 25 basis or 50 basis, would have made some commentary about higher for longer that they've been saying over the last 6 months, and then people would have baked in the terminal rates possibly where they were pre-policy, or maybe increase them depending on the commentary that the Fed was to make. I think this time it's very critical because Fed is really in a very, very unenviable position. They know that inflation is coming down, but not at the pace that they wish, because they are stuck to this 2% rate, whether it's Europe or it's the US. Some people may argue, why this fetish for 2%? Why not give yourself some more allowance? But we leave that for another discussion. Inflation refuses to come down from 6 to 2 as fast as the Fed wants. Therefore, they want the rates to remain high. But equally, the events of the last 15 days have proven to us that there is collateral damage on account of higher interest rates. Let me be honest, I think many of us did not realize that higher interest rates is not going to be a credit event, but is going to be a massive liquidity event. And we cannot just brush away by saying that this liquidity event is more idiosyncratic and it has happened more with Silicon Valley Bank kind of banks who've had an asset liability mismatch. It is actually hurting many of the other banks. So therefore, in this situation, what do? If you keep increasing interest rates, keep being hawkish, you really have a problem in the banking system. And if you refuse to increase interest rates, the inflation remains, inflation is coming down, but it doesn't come down at an accelerated pace. So I think this would be a first policy in many, many quarters where the Fed really will have to rewrite the script. They've been writing one very, very consistent script over the last 15 months, which is we are watching the inflation data and increasing rates. If inflation doesn't come down too quickly, we will keep interest rates higher and higher for longer. They may have to depart from this. And I think that's why, like you said, it's a very, very critical policy today to really get to understand what's the Fed thinking about balancing these two things. So I also have more questions than answers at this stage, but I clearly know for a fact that this will have to be a slight departure from the past. Number two, if you ask me what's my own opinion on this, I think while inflation is an important metric to get into the ballpark or the sweet spot, but I think the most important thing for any central banker is to basically have a very stable financial system and to have stability in the jobs market. I think that is pretty much at stake right now, and hence the balancing act.
Yeah. Ajay, it almost seems that the market is now penciling in not more than 25 and a bit of a positive, dovish, if not a turn, then at least sound from the Fed. If that doesn't come, for whatever reason, if it doesn't come out, do you think there will be a bit of a pullback in risk assets by and large?
Absolutely. I think you're absolutely right. There is an 85% consensus for 25 basis. 50 basis is thrown out of the window completely. And of course, there is a short segment of the market who feels that there may be a pause. The ECB actually, in some sense, preempted this whole thing by increasing interest rates. And therefore, the Fed will have to have a very strong reason for saying, look, ECB did it, we are not doing it. In a way, when they say this or when they do this, they may possibly allude to the fact that our banking system is more in stress compared to Europe. So therefore, the consensus that 25 basis is the most plausible thing right now. If you don't do anything, you're sending in a message, look, the health of the banking system is precarious. So I think that's one bit. Yes, if they turn hawkish, while on one side, they may say, oh, we are very sanguine about the banking system. We are not worried. In any case, we are trying to address this using very different measures, liquidity being one of them. But I guess this will really be extremely pernicious for the banks, especially the smaller banks, because what we are very clear about in our analysis of the last 15 days is that this massive increase in the yields, which is unprecedented over the last 20 years, has had an unprecedented impact on the mark-to-market, treasury book of all the banks, which has now started impacting their profitability and therefore will start impacting their net worth as well. So I think you're right. If Fed was to be hawkish, then it will certainly have very, very negative consequences on the banking industry and risk assets in general.
Hmm. So in light of that, let's assume that the unthinkable doesn't happen and it is 25, it is moderately hawkish, moderately bullish, whichever way you, or dovish, whichever way onlookers want to look at the Fed statement. What happens to the RBI's hand, and what happens to the Indian markets in light of that? Let's assume global markets kind of stay constant, don't deviate too much. What's your thought on India then?
So I would say if it's 25 basis and dovish, it's good. It's good for basically the real economy. And in the real economy here, we are right now concentrating on the banks. So it's good for the banks in general, globally. See, the Indian banks actually were never in that bad a situation. And sometimes, people like you and me wonder that is our central bank ahead of some of the other central banks? Because, we took those mark-to-market losses in the last 3 quarters itself. I mean, I remember, without naming, a few private sector banks which had a disproportionately higher, longer dated treasury book, and they took those losses in first quarter of the present financial year itself. So in some sense, we were taking it very, very systematically quarter after quarter. Of course, to be very fair, for us, the yield increase possibly was just about 200 basis. So the delta was not as much as in the case of the US. In US, they've never seen it over the last 30 years. So yes, that's where we just need to be fair. But yes, be that as it may, I think for us, the danger of a further increase in interest rates and this increase continuing for at least 2 or 3 more policies is not a big risk for the banking system. Yes, it is bad for so therefore, it's not as bad for the real economy, but yes, it is bad for the markets in general, risk assets in general, and we all know that emerging markets as a block are basically furthest right on the risk spectrum. So the flows to emerging markets, including India, in such a scenario do get impacted. So I think that's what I would suspect. 25 basis and dovish commentary is good for everyone, including the Indian markets, because it basically means that the Fed recognizes that they may have to pause now, and the pause could be sooner rather than later. Plus, the cuts and the reversals could also be sooner rather than later. Let me give a data point to your viewers here. Exactly 15 days back, we were talking about no interest rate cuts through this calendar year and the cuts happening only next year. And we were talking about at least 75 basis points higher rate compared to, let's say, what they were in January. In the last 15 days, I think, first of all, the consensus has shifted only to just one last 25 basis point hike. More importantly, the consensus is now talking about 50 to 75 basis points of rate cuts in this calendar itself. So the event of the last 15 years really have, borne out the chinks in the armor, as they say, and the Fed cannot ignore and just keep talking only about inflation anymore.
Yeah, fair point. So were you guys at UTI sitting on some cash? I mean, by some cash, I mean slightly larger than normal. And have you been tempted to deploy as a result of the turn in the market expectations with regards to the cuts? We don't know what the Fed will do, but at least the market expects it to do something different. So have you been tempted to deploy some of that gunpowder?
So Neeraj, that's an important question you've asked. And philosophically, let me answer by saying we don't actually believe in cash.
Okay.
We've seen these cycles in the past. We know how tempting it is to increase cash, but we also equally know that you get trapped because markets have this ability to suddenly surprise you, both on the negative and the positive. So we've just realized that philosophically, as a part of our investment process, we should not be raising cash. We would tactically raise cash in case we feel that the markets are such that there could be heightened redemptions in the coming weeks. Only to be prepared for that, we would. But as a principle, our cash levels in our different schemes vary between 1% at the lowest to 5% at the maximum, and nothing beyond that. Yeah.
Okay, but did you so whatever cash you had, I mean, have you been tempted to deploy it under the current slight change in the expectations thereof?
I would say the markets over the last 1 week, because the Indian markets, as we all know, have also corrected. The markets over the last 1 week certainly have given us more opportunities. So yes, on a case by case basis, wherever we're seeing that the stock prices are cracking down, more on account of the near-term sentimental factors rather than the prospects of the business over the next 3 years, we are inclined to use this cash. And it has happened in the last 10 days where there has been a bit of a disproportionate movement in certain stocks and sectors, more on account of the sentiments. Yeah.
Yeah, well, so IT comes to the fore, Ajay. Would love to understand your thoughts. I was reading a Morgan Stanley note on HCL Tech today. They took the company to a US investor day, and the company said that they had 99%, 9 plus exposure is to large banks and insurance and BFSI and not to regional banks. And therefore, they sounded confident that they won't get impacted. The flip side is that people argue that it may not just emanate from banks itself, but from a bunch of other sectors which might get impacted because of liquidity as well. So my question to you is, are you sanguine on IT? Have you used this correction as an opportunity, or are you not so constructive because the clouds are too many to judge what could happen?
I think, Neeraj, that's a very important question that you've asked. And I think IT is front and center for most investors today, because that's one sector which has a very strong correlation with the US economic outlook and what's happening there. Now, our views on this. See, before I discuss points specific to the sector in general, let me start by saying markets are extremely forward-looking. This is one asset class which looks out 4 quarters, 6 quarters, sometimes even beyond that. So therefore, please do accept the fact that sometime in December of 2021 and January of 2022, there was this lurking feeling that interest rates are going to increase, and whenever interest rates increase in the US, they do impact the growth. When growth decelerates, the focus of organizations around the world and in US as well is more on margin protection. When you start to protect margin, you lay off people and you also reduce discretionary things like IT budget. So I think that was the context in which we have seen a 30 to 40% decline in IT stocks over the last, I would say, 12 to 18 months. Now, to repeat the same logic today that, look, US is headed into a recession is in a way double counting, because, then you have to explain that why did stock prices come down by 30, 40% in the last 12 months? Because their profit growth has been very, very strong in FY23. So these stock prices were basically discounting the softness that one is to see in FY24, possibly some part of FY25, and then business as usual. So I think that's point number one, which all of us have to acknowledge. Now, point number two, how resilient is the IT industry? I would say, if you go back and observe these recessions in the US, whether it's the dot-com bust-led recession between 2000 to 2002, or it's basically the financial crisis-led recession between 2008 and 2010, in all of these events, around the event, a few quarters before and a few quarters after, there certainly was uncertainty. But the one thing that we have learned fundamentally from these episodes is that Indian IT actually gains more and more strength. Remember, I just said that during uncertain times, the one thing which all organizations wish to do is get back to their core, leave out the attempts to diversify, and concentrate on margin improvement. IT as an enabler of improving productivity and raising margins is a sector which has made itself relevant through many of these recessionary cycles. The script will be repeated because whether it's Facebook or Amazon, all of these guys have realized that they're not going to throw money away by getting into newer businesses. They need to conserve cash. They need to have a solid balance sheet, and
Sure.
they need to improve productivity. The importance of IT outsourcing players as their partners is something which gains even more traction. Yes, there could be some bit of budget stalemate for a couple of quarters, but if you and I are investors not looking only at the couple of quarters, but the scenario 2 or 3 years down the line, I would say, like in the past, people would be pleasantly surprised to see that these companies come front and center, during recessionary times. Yeah.
So the only question is that, to your answer, I would have accepted it wholeheartedly, but for the fact that the last 15 days there is an SVB issue that has happened, you don't think that will have any collateral damage first?
So I would just in a way reiterate, which is that it may have a damage for a couple of quarters, because for a couple of quarters people just want to wait and see. So for a couple of quarters, instead of increasing their IT budgets, they will say that, look, let's just go ahead with whatever we have planned, and let's just see how the dust settles down. But that's a situation which doesn't have a shelf life of more than a couple of quarters. After that, as the dust inevitably settles down, corporates and the really resilient forward-looking corporates come out and say that, look, again, go back and improve productivity. This is one very important source of productivity improvement. So therefore, let's concentrate on this. So I think that is something where, as a team, we are extremely confident, and therefore, while I may not able to tell you whether the stock prices could see another set of correction in the coming months or quarters, but I think we are very, very confident about their business outcome over the next 3 years. In fact, like I mentioned, their relevance would actually only improve because of this recessionary trend.
So aside of banking, which I presume marked to the index, you might be equal weight or overweight on. Your answer suggests that IT, you seem to be overweight, maybe marked to the index and equal weight, but constructive. Let's put it that way.
Yes, we are constructive.
Where else, Ajay, from the slightly smaller pockets than IT and banking, are you most constructive on from a 12 to a 24-month perspective?
Sure. I think, Neeraj, we are constructive on healthcare as well. If you look at one sector which has taken it on its chin in the last 12 to 24 months, it's been healthcare, and it's been for a variety of reasons. Let me get the technical reason out of the picture first. The technical reason was a very, very high base effect. During the COVID years of 2020 and at least the first half of 2021, most of the healthcare companies, in which I'm including the healthcare services firms like diagnostics as well, did have a massive bump up in their revenues, because obviously globally all governments were thinking of stocking up medicines. They weren't even concerned about, look, how much is enough for us. They were all in a race to have as much inventory of medicines, which even remotely could have been beneficial for a person who's going a COVID treatment. So there was a massive stocking exercise. Their bases went up. In case of diagnostics, there was massive testing that was happening, mandated by the government and the regulation and the regulatory bodies themselves. From that base, it was only obvious that they would come down to normalized earnings. The second factor was that instead of stocking up, what happened in the next 12 to 24 months was destocking, because most governments around the world and most intermediaries around the world realize that, look, we have enough stock of medicines. Why do we need to buy now for the next few months? Because medicines do have a very short shelf life. So a destocking cycle happened. While all this was playing out on the top line, unfortunately, because of massive increase in commodity prices, the margins of all pharma companies came down significantly. At least I haven't seen a massive crack like what I saw in 2021 and 22 in the last, I can say, 23 years that I've been an analyst. So I think all of these things came out together, and inevitable happened, which is that the valuations swung on to the other side. And I think all of this today is at a juncture where we feel that there would be a reversal in the coming year. So we do see a reversal in margins. We do see that an inventory destocking exercise has completed. So therefore, the normalized revenue growth will come back. And as it comes back, this is one sector where stocks are trading significant discount to their long-term averages. Most sectors we look at are still, in a way, slight premium to their long-term averages, this is one sector where we are still down compared to long-term averages. So I think if you really have that patience, I think this sector does have some very, very well-managed companies. I can't get company specific here in this discussion, but yes, enough to say that um, this is one sector where we are constructive.
So you're talking about US focus, US generics, or are you also including, say, CDMO API, diagnostic and hospitals? What part of healthcare?
No, so Neeraj, I'm including everything here except for hospitals. If you look at it, all the other segments of the healthcare sector have come down. The CDMO companies have taken a big knock. The India focused formulation players have taken a big knock. The US generic companies have also had pressures in the last couple of years. So I think I'm here talking about the sector as a whole. Investors just need to dig deeper into their favorite pockets and gain conviction. But the entire sector is today facing the very issues that I spoke to you about. Those issues have been relevant for the entire sector.
Okay. Ajay, before we wrap up, where is it that you are not constructive? Or you might be at contrarian stance with the index, with the market at large, but where is it that you are not constructive?
Sure. So I think the part of the market or the economy which is extremely vulnerable to global growth is the one where at least I am not constructive now. And I must say, Neeraj, that we don't ever take a house view at UTI. We have different funds and different strategies run by different fund managers. So my value fund manager may still be constructive to some extent on commodities, but that may not be true for me because I focus more on the quality growth side of the market. So the statement that I'm going to make now is not a house view of UTI, but I'm making this in the capacity of a fund manager. And my sense is that sectors which are heavily indexed and related to global growth are going to really find it very difficult. So if you are really seeing, and I don't think we really need to do a lot of data crunching to lead to the results that global growth is going to be much softer in calendar 2003 and possibly into calendar 2024. So commodities, energy, these are sectors which would really be negatively impacted. So I think that's where we need to be really cautious. They did see a massive upswing in 2020 and 21. They've already seen signs of that massive demand pull-led price increase in various commodities cool off. The anxiety around supply chain bottlenecks due to the Ukraine war. Unfortunately, the Ukraine war is still continuing, but the anxiety related to that has also waned away. And if growth really remains soft, and there are enough signs for that as of now, commodity prices will continue to get marked down, which is bad for these sectors. So that's where I am not positive at all and very, very watchful.
Lovely talking to you today, Ajay. Thank you for taking the time out and giving us a lowdown. And let's wait to see what Jerome Powell and team have to say tonight. It'll be important for the weeks ahead. Much appreciate you giving us a bit of a curtain raiser of sorts into what could happen.
Thank you. Pleasure talking to you, Neeraj.
The pleasure was ours, and viewers, thanks for tuning into this edition of The Talking Point.